right, class. Welcome to chapter 10. You're on the downhill stretch. Hang in there. You're all doing great. You have the highest average on exams of the whole college. I just want to let you know that. Congratulations. So, I want to go over a few examples for chapter 10. And at the beginning of this spreadsheet, I've put in all of the formulas for you. So you can refer back to those. I want to start with mini exercise 10-7. So we have a company and we're asked to calculate their ROI, or their return on investment, and their residual income. ROI is net operating income divided by average operating assets. So net operating income is $310,000. And average invested assets, or operating assets, same thing, is $940,000. So 310 divided by 940 is 32.98% return on assets. Or return on investment, sorry, ROI. There's another way to calculate this, and I want to point this out because sometimes you don't have enough information to do this simple calculation. ROI is actually margin times turnover. So if you calculate your margin and you calculate your turnover, you can get your ROI. So margin times turnover. Margin is net operating income divided by sales. So net operating income of $310,000 divided by sales of $520,000. And this is a really common calculation that's used a lot. So we take the 310,000 and we divide it by the 520,000, and we come up with 59.62%. Turnover is sales divided by the average operating assets. So sales, in this case, sales is how much? 520,000? Yes. Divided by the average operating assets of 940,000. And that would be 520 divided by 940, or turnover of 0.55. So the problem with the ROI calculation is it incentivizes not increasing your assets, which is not always a good thing, because if you have too much in operating assets, it reduces your turnover and lowers your ROI. So ROI is your margin times your turnover. So this times this, 32.98%. Okay, residual income is operating income minus your average assets times your hurdle rate. So here's the thing. They have a hurdle rate of 10%. That means they don't invest in anything unless they can get at least a 10% return. Residual income is the amount over that. So your operating income, your operating income was $310,000. Your average assets times your hurdle rate, so your average assets is 940,000, your hurdle rate is 10%. So that would be 940,000 times 10%. That's 94,000. So my residual income is 310,000 minus 94,000, so that's 216,000 residual income, over and above what I require as a minimum. Okay, mini exercise 10-8. In this one, it gives some information on sales, cost of goods sold, operating expenses, and average invested assets with a hurdle rate of 6%. Again, calculate return on investment and residual income. Net operating income. In this one, it didn't actually give you the net operating income. You've got to calculate it. So it's 140,000 in sales minus the 70,000 in cost of goods sold minus the operating expenses of 20,000. Gives us 50,000 net operating income with average assets of 400,000. And just so you know, average assets, if they don't give it to you, is beginning of the year assets plus end of the year assets divided by 2. Simple average. So your ROI for this company is 12.5%. And then you can also calculate it this other way down here, where you take net operating income, which was 50,000, divided by sales of 140,000. And that gives us a margin of 35.71%. Turnover is sales over average operating assets, 140,000, over average operating assets of 400,000. And that would be 140 divided by 400, 0.35 turnover. So then my ROI is my margin times my turnover. Or 12.5%, same thing. Residual income on here is that operating income that we calculated before. So the 50,000, I don't want to calculate it again, minus the average assets, which is 400,000, times the hurdle rate of 6%. Or 24,000. My residual income is my operating income minus my hurdle rate income. So 26,000. On this one, we're going to run some numbers because it says it gives us information and it says they have an opportunity to increase operating income by 12,000 with a $108,000 investment in assets. What is it? What are their current numbers and what are their numbers with the new project? So we're just going to basically do net operating income, which is 135,000 divided by average operating assets, which is 560,000. ROI of 24.11%. Residual income, so my operating income, again, 135,000. And then I want to take my average assets of 560,000 times my hurdle rate of 15%. Gives me 84,000. So my residual income is then 51,000. If I take on this new project, what happens? I'm going to increase my operating income by 12,000. So I'm going to take my operating income here and I'm going to add 12,000 to it. What in the world did I do here? That's better. I don't know what I did. And my average operating assets are going to increase by 108,000. So I'm going to take my original 560,000 and I'm going to add 108,000. So my new ROI is 22.01%. And this is that effect I was talking about. If I get a $108,000 investment in assets, I'm increasing my assets. So that's reducing my ROI. So I would be tempted not to do this. But let's take a look at residual income as well. So my operating income, my new operating income, is 147,000. My new average assets are 668,000 times my hurdle rate of 15%. So my residual income is now 46,800. And before it was 51,000. So both of these indicators are saying do not take on the new project. Of course, there are other issues that you might want to consider, non-financial issues, as always. Mini exercise 10-12. We're looking here at transfer pricing. So if a company has two divisions, East and West, East manufactures a component that West uses. The variable cost to produce the component is $2 per unit. Their full cost is $275, which would include the fixed as well. The component sells on the open market for $3.10. If East has excess capacity, and if you remember back to the excess capacity issue, what is the lowest price East will accept for the component? The lowest price they're going to accept is the variable. Oops, I'm in the wrong spot here. The variable cost of $2. Because they have excess capacity, as long as they cover their cost, it doesn't matter. Fixed doesn't change anyway. What's the highest price that West is going to pay for it? Well, if it sells on the open market at $3.10, that's the highest price they're going to pay, period. They're not going to pay more than that because they can go get it on the open market for $3.10. Okay, that's a minimum and maximum transfer price. Cost plus transfer pricing. It basically says we take our variable cost plus a percentage. So this company has two divisions, wheel and chassis. Wheel manufactures a piece that chassis uses. The variable cost to produce it is $4. The full cost is $5. We're presuming that the dollar difference is in fixed cost assigned to that. The component sells on the open market for $9. What would the transfer price be if Medlock uses a pricing rule of variable cost plus 60%? Well, it's pretty simple. You're going to take variable cost plus 60%. So times 160 or 1.6%. So I've got to get the 60% plus the original cost. So that brings it up to $6.40. This chapter's not too horrible. The formulas are not bad. There's just a few of them. And the more you do them, the less you have to worry about memorizing formulas because you'll actually just know those. And even if you're not going to be an accountant, if you're going to be in business, you'll want to know these ratios. When we get to chapter 12, there will be some main ones that you'll be expected to remember, but the rest of them you just look up. Okay, have a great week. Thanks as usual.